Hi, my name is Andrei Jikh. Hope you're doing well. Come for the finance and stay for the not financial advice. What would happen if we got another pandemic? How would we invest differently knowing what we know about 2020 today? Now, if we could get into a time machine and travel to the year 1985, save the clock tower. If we could time travel to the year 2020 to March, when the stock market took its biggest hit, what would we invest in? Now, obviously, hindsight is 2020, but we would load up on a ton of tech stocks, right? The Apples, the Googles, the Amazon, Netflixes, the Teslas of the world, and maybe we'd short some of the recoveries, some of the airlines, the cruise lines, maybe some of the casino properties. We'd buy up a bunch of crypto. The reason that I'm making this video is that there's a chance that we might not need a time machine at all. And that's because the COVID variants are starting to spread. In fact, places like LA are starting to restrict parts of their businesses, and the mask mandates are slowly seeing this comeback, and that's scaring a lot of people. In fact, the stock market took a huge dip on Monday because of news like this. And so I thought to myself, if this happens again, knowing what we know about 2020, how would we do things again? Would things play out differently, or would they be the same again? And that's what this video is about. So here's my thought experiment about how I would invest if something like this were to happen, not financial advice. All right, so first let's take a look at some data, because data is really important. And if you go directly on the CDC's website, this is the thing that doesn't look good. So this curve right here should not be happening to this degree if this were 100% over. And you can actually see there's a rise of COVID in the reports to the CDC. There's also reports of several variations of the virus, and keep in mind, I don't know all of them, but some of the ones you might have heard of are called alpha, beta, delta, and gamma variants. Now this next part is just in case you were thinking about traveling, so let me throw some numbers at you. Because the alpha variant was first detected in the UK, beta in South Africa, gamma in Brazil, and delta in the US and India. And out of all of these variants, it's just our luck that Delta is the one that's the most contagious. And that's because at the beginning of this month, roughly 50% of COVID cases were because of this Delta variant, but now that number is up to 83%. So it's actually spreading fast. And that's because it's anywhere between 43 to 90% more contagious than that first strand. So now half of Congress has started to wear their masks. And what's crazy is that even though 68.3% of all US adults have at least one vaccine, those people in Congress, some of them have tested positive despite getting their vaccines, which is kind of terrifying to think about, because here we are thinking that the worst is behind us, and we're back at it again, Daniel. Now, I don't want to scare anyone, but the best thing we can do is, once again, wash our hands, don't touch our face, stay 6 feet away, get vaccinated, and smash that like button. And if you already got vaccinated, your odds of getting sick are significantly lower than if you didn't get a vaccine at all. Now, that's the good news, is so far nothing has happened. But if they were to happen, here are some good signs to watch out for, and here's what I would personally do. First, I would corner the entire market by buying up all the toilet paper, all the used cars, and all the lumber I could afford, because people will always need to use toilet paper, they'll always need to use lumber to build new houses, and they'll always need cars to go to work, and they'll always need to smash the like button. Score. Half kidding. Now there's a few signs that you should watch out for to know that something is about to happen. And the first of these signs is the stock market will move very fast, especially once the narrative changes to be more about fear. And that's because as soon as people get scared, they sell off very quickly. And that's because between February to March of 2020, the stock market sold off something like 30%, which is huge. We had several days of the week where we had almost double-digit drops. March 9th, that was the Black Monday, where the market dropped something like 7.8%. Then we had Black Thursday on March 12th, where the market dipped 10%. And then we had a Black Monday part 2, where the market fell almost 13%, which is insane. You know it gets bad when days of the week start to get names. Now by themselves, these days are historic, but for them to happen back to back to back like that means that something really bad is on the horizon. Now, if you were smart enough to buy the dip, then you would have made a lot of money. But if 2020 were to happen again, here are some of the stocks that I would look at: VOO, VTI, and SPY. Now, if those stocks moved 5 to 10% in a single day, that's when I know that something is about to happen, because the stock market freaks out if they fall 2% in a single day. So if they fall between 5 to 10% or even more, that's when you know that something really bad is on the horizon. Now, the second lesson we learned is something that will 100% be true again. And that is, if you didn't panic and if you didn't sell your stocks, you would have made more money than most other people in the market. And all you had to do was nothing. Because sometimes doing nothing is literally the best move you can make, especially when it comes to dating. Because girls make up their mind within the first 5 minutes of meeting you, and sometimes all you have to do is nothing and just don't mess it up. Come for the finance and stay for the dating advice. But the third thing to watch out for is tech stocks, because we learned that tech moves extremely fast, and without tech, the stock market would look very different. Because tech represents 27.4% of the S&P 500 index. And if you remove tech from the equation, then the stock market would actually be down, even though in 2020 it looks as though it made money. But the only real reason it did is because tech carried the whole weight. So personally, I would watch for stocks like Apple, Amazon, Netflix, Google, Facebook, Tesla. Even some of the smaller stocks like Zoom and Etsy could take off if something like this were to happen again. And if you're saying to yourself, well, if I know that, I'm just gonna sell off my entire stock portfolio and just dump everything into tech because I know it's gonna take off and go to the moon. There's gonna be a very big problem with you trying to time the market, which I'll explain later in the video. But if you're somebody who already has a ton of tech anyway, you might not have to do anything. But since I don't, it might be a good buying opportunity if I could catch that initial wave of fear, right? Now, the stocks that are going to go down the most are once again going to be the United Airlines, American Airlines, Caribbean Cruise, Norwegian. It's going to be the entertainment sector. It's going to be the restaurants, the travel industries, because if there's travel restrictions, that means less energy consumption, and that means the energy sector will also be affected. And that means stocks like ExxonMobil, Chevron, Shell Oil, Kinder Morgan, OneOK, all stocks that I own or have owned at some point in the past. And all of those stocks I just mentioned are going to drop. In fact, everything in the market will drop on that first wave of fear. And if you're somebody who's a dividend investor and you love your passive income, then a good sign to pay attention to is the dividend income. And if those companies start to shrink or get rid of that dividend income, then that could be a bad sign of something on the horizon and they're just preparing for something bad. So that's something to watch out for. But I think the biggest sign and the biggest lesson that we've learned from 2020 is don't fight Papa Powell. Don't fight the Fed just means don't try to predict what the market's about to do, just follow what the central banks are doing and you'll have a rough idea of what's about to happen next. And there's one chart you need to pay attention to, and that is the total assets held by the Federal Reserve, which is this chart right here. So when people talk about printing money, that is the chart they're looking at. When people talk about quantitative easing, that's the chart they're looking at. Because on February 26th, when we all realized the Llorona's real, that's when we pumped trillions of dollars into the system. Now, right now, we're printing about $120 billion a month, which is a lot, but that's nothing compared to what happened in 2020. So if it were to happen again, that is the chart you should be paying attention to. And the more the Fed gets involved, the faster these markets will move. So just really pay attention to that. And the other thing to pay attention to are inflation hedged assets, because those narratives were very powerful in 2020. Gold, for example, went from $1,500 an ounce to $1,900 an ounce between January to December of 2020. That's a 26% increase, which is crazy. But then you talk about Bitcoin. It went from $7,100 a coin in January to as high as $30,000 by the end of the year, which was a 313% increase. And I think that's because people realized that Bitcoin was a better, faster digital gold than even gold was. But that was the first pandemic. If another one were to happen again, I think those inflation hedged assets would boom even higher. And that's because in 2020, there were a lot less people invested in Bitcoin than there were in 2021. And this whole narrative that inflation is transitory, which is what we're told, is something that people will not buy anymore. And then of course there's real estate, which is something that I don't think any of us could have predicted. First, median home sale prices dropped, especially in the biggest cities where the experience of not having a job is literally the worst, right? So as unemployment levels spiked, we had the Fed and the government step in, and this is where the saying "don't fight the Fed" comes in, because what they did was they dropped interest rates to zero, and then we flooded the economy with stimulus checks, unemployment benefits, we had mortgage forbearance programs that definitely helped people out. But what it did was that it forced people to stay at home because we shut down these non-essential businesses. But because people were at home, they were saving money because they weren't spending any money. And that's why the savings rate jumped up to 33%, which is literally the highest it's ever been. And by July, we saw the lowest inventory levels in the real estate market because I don't want to sell my house to a stranger in a pandemic. They're not going anywhere near me. But because interest rates were still at zero, it created a buyer's market, except the buyers didn't have much to pick from. And that's why it squeezed the average home sale prices higher. Now, a lot of what I said in this video sort of repeats the exact same circumstance. Like, sure, Andre, if the exact same things were to happen, we could predict the result. But the truth is, it's probably not going to happen identically as it did in 2020 because there are two major differences. It's debt and Congress. Debt is obviously something a lot of these companies took on in 2020. So airlines and especially cruise lines borrowed a ton of money just to stay afloat. No pun intended. And that means a lot of these companies are sort of stranded on thin ice, which means they could sink, and that means that a lot of them could end up underwater. What I'm saying is a lot of these companies took on so much bad debt that you should be careful not to buy stocks like Carnival Cruise thinking, well, wow, it's down a lot today, but I know it's eventually going to triple in value just like it did last time, because the truth is a lot of them won't be able to take on that same amount of debt, and maybe they won't even survive. So just be careful and don't make that mistake. And a really good metric to look at is something called the debt to equity ratio. Now, in a normal environment where normal companies, they would have anywhere between 1 to 2 in terms of a debt to equity ratio number. That's not true for everything. Financials, real estate, manufacturing can all sometimes be 3 or even more and be perfectly fine. It just depends on which sector you're talking about, but if it's far above 2, you might want to be careful and reconsider what you're buying. The second major difference is Congress, because last time we had a Congress that was sort of split down the middle. We had a Republican president, but we also had a Democratic House of Representatives and a Republican Senate, which means those stimulus talks that were negotiated were sort of delayed constantly, which means there wasn't as much stimulus as there could have been if we had a Democratic trifecta like we do now. We have a Democratic president, we have a Democratic Senate, and a Democratic House of Representatives, which means if and when support will come, it will come fast and it will come hard. Now, the benefit of this support and this Democratic trifecta is that we probably won't have to wait for very long for our stimulus checks because there's going to be a lot of money for everybody. But the downside is more than likely we'll see a lot more asset inflation than before, which is great if you're somebody who's already invested in the markets. But if you're not, that K-shaped recovery that people talk about is only going to get worse and people will get left behind. So personally, here's what I'm planning to do. I'm going to take on a lot more debt, especially if there's opportunity in the real estate and crypto markets. So if Bitcoin falls below $20,000, I'm buying. If Ethereum falls below $1,000, I'm buying. If interest rates fall to 2%, I am buying. And if stocks fall more than 5% in a single day, I'm buying. If there's one thing that I could say about investing though, and selling your entire house to bet everything you have on tech stocks, is that the moment you pivot strategies and the moment you try something different is when you start to lose money by trying to time the market. Please remember that trying to time the market just means you're probably going to lose money, and I know I've said this 1,000 times, but I have to say it again because if you started with $10,000 20 years ago and all you did was buy the S&P 500 and you did nothing, today you'd have $30,000. But if you missed the top 10 trading days, just the best 10 days in the last 20 years, just 10, you would have $15,000. But if you missed the best 30 days in the last 20 years, you'd have less than what you started with. So please don't try to time the market. You'd have to know where the top is, where the bottom is, and even if you time that correctly, you'd have to know when to sell when we rotate out of tech, which means you technically have to be right 3 times, which is virtually impossible. So please just don't try it. As always, don't forget to smash the like button, subscribe, and go get up to $250 worth of free Bitcoin using this BlockFi link right here, blockfi.com/Andre. Go get their credit card. They just opened it up with this BlockFi link right here as well. Go get your 2 free stocks with Webull. When you deposit $100, you can get 2 free stocks valued up to $2,300, and then go track them automatically with the spreadsheet linked down below in my Patreon. Love you. Thank you so much for watching. As always, I'd love to know your thoughts in the comments down below. I'll see you back here on Monday, Friday, sometimes a Wednesday. I'll see you soon. Bye-bye.